It's a concept called ring fencing, where if company A, B, C come together and they contribute together, if company A by coming together has a right to a particular set of assets, only to a particular set of assets, not to entire assets by way of an agreement, then only that part will get consolidated. Right? Just to give you an example, A, B and C each lease separate billing A, B, C respectively, which are owned by lesser investor. A, B, C are considered investor because they may be controlling the investment. A has a fixed price to purchase. A has fixed purchase price option to purchase billing A for 1 billion. No such options are there for billing B and C. Now in this case, since company A has a purchase option and the loan amount and the billing value is also same or equivalent, it will consolidate directly in billing. Whereas in B and C case, first is they don't have option to buy, and second, the entire debt is not supported by the property. In that case, B and C will not do consolidation. It will have a limited assessment in case of investment property or in case of continuous assessment. We have seen that, actually we have discussed this many times, that each year we do the assessment. Each year we have to do reassessment, and in case reassessment changes, your consolidation control can change. If your control is changing, you will consolidate. In the second year, if there is no control, you may do associate account. Right? Now, the assessment is continuous and it can trigger consolidation not only because of your actions but also because of the market actions. Right? So, just to give you an example, cycle 41, where before and after, both the situation, you are holding 48%, your holding doesn't change. But the 52% remaining was widely spread earlier. Now, nothing changed in you, nothing changed in your relationship with B. That continued with 48%. But the other investors got consolidated. Instead of widely spread, now there are only 11 investors. Right? So, earlier it was very easy for A to control. But now in the revised situation, it is very easy for those other investors to come together and outvote you. In this case, the control definition might trigger a change. Right? So each assessment, this assessment will be done every year, and it may not happen only by you or by your relationship with the investing, but also because of the market condition. Right? Okay. Yeah. So I agree. So there is no yes or no answer to it. We have to see whether. So if in this kind of case, where investors are limited, then it will be difficult to control. Now again, the standard also recognizes that, and it says, if there is any doubt, don't consider. In fact, the standard government 2, which is actually gives all the disclosure requirement, that has got a very stringent condition to give all the disclosure, whether you are consolidating in these circumstances. Why are you consolidating? What is the rationale of consolidating? If you are not consolidating, then also you need to give the reasons. What is the justification? What is your thought process of not consolidating? So whether you consolidate, not consolidate, you have to give reasons in the financial statement of why you have chosen a particular decision. So audit challenges we have discussed. There are many audit challenges in terms of, as you said, whether 11 investors are there or 15 investors are there. It's all important. Okay, coming to investment entity. At the outset, actually, we had said there is a definition for investment entity. Now, sir, you had raised what is investment entity. So these are the definitions. An investment entity is an entity which obtains fund from one or more investors for providing investors with professional investment management services. Commits to investor that its business purpose is to invest funds only for returns from capital appreciation or investment income or both, and measures and evaluates the performance mainly by investment on a fair value basis. So these are the characteristics of investment company. If the company is investment company, then the investment made by the investment company, even though control is triggered, it will not consider. Because the whole objective is to make investment and earn money either through capital appreciation or through dividend or both. Now, the exemption is given only for the investment company, right? investment company making investment in company ABCD will not consolidate. But a company owning investment company will consolidate. So if company A is an investment company and A has invested in many shares, say Reliance, Tata Steel, XYZ. Now XYZ, the holding is more than 50%, right? Even though holding is more than 50%, even though the control is triggered, but being investment company, it will not be consolidated, right? But now, the same company has got a parent company, H Limited. H Limited will have to consolidate if H is not an investment company. Just to give you an example, on slide number 46, parent company is not an investment company. Below it, it has a fund where it owns 60%, and below the fund has the investment company. You have to. The investment company has invested in a further companies, right? In this case, the fund being investment company will not consolidate. At second level, there will be no consolidation. But at a parent company, which is not an investment company, the consolidation will be required. See, so in this case, okay, so to answer it, in this case, what parent will consolidate will be only fund limited. The investment which are made by fund, the investment will be made fair value. So probably signal over the subject now. Fine, I think we'll take just another 10 minutes and I think we'll complete it. Here it is clear, right? This concept is clear.
So the final entity in which investment has been made for more than 60% it will not be considered. It will be at
only at level 1 or you
yeah.
Your question is on level 2 also.
the parent will consolidate the investment fund.
Right. That's
not below.
Not below. Because those investments would be anyway at a fair value to be. Now, I mean, broadly we have covered the consolidation topic. Now, just very briefly, what are the differences between IND-AS and the Indian GAAP? Under Indian GAAP, the minority interest, wherever there was a losses to minority interest, used to restrict up to 0. If the losses used to exceed as compared to minority share, the losses were not getting absorbed or were not allocated to minority interest. So minority interest in Indian GAAP would be either positive or it would be 0. That has changed, right? Under IND-AS, even though there are losses, the losses can be attributed to minority interest. Even though the non-controlling interest is negative, still you can allocate. Non-controlling interest can be further negative. So that's a major change. Now the second one, financial statement of private subsidiary companies used for preparation of CFS will be prepared at the same reporting date. So here there is an exemption under IND-AS that the timing gap between the holding company and subsidiary company accounts could be 3 months, whereas under Indian GAAP it was 6. So that's another minor change. For disclosure purposes, there is a change. Minority interest used to show neither in liability nor in equity. Those are separate line items in liability and equity. Under IND-AS, non-controlling interest comes as a part of equity. So one is owner's equity, and after that there is non-controlling interest, and then there is a total equity. Yeah. But as far as ratios can change here in this case. So earlier there was not forming part of equity. Under IND-AS, it will form part of equity. Uniform accounting policy is mandatory. Under Indian GAAP, also it was mandatory, but there was an exemption that if it is not practicable, you may not do it. Okay. Slide number 51, which we have covered in detail initially, but just to repeat, if there is a change in ownership, not resulting in loss of control, then the transaction will be accounted in equity. It will not change your goodwill or it will not change your P&L, right? So if the holding comes down from 60% to 55%, there will be no change in profit and loss of goodwill. Whereas under Indian GAAP there was no guidance, and in there is no guidance. Generally, the practice was up to 5% the profit earned was recorded in P&L. Similarly, if the control is lost, under Indian GAAP we used to do proportionate share transaction sold and proportionate profit or loss used to go. Under IND-AS, the situation is completely different. Once you lose the control, the entire holding will have to be fair value. So if your holding comes down from 60% to say 30% or say 60% to 20%, the 40% anyway will go as sale, but the remaining 20% also will be fair value, which was originally at cost, will be at a fair value, and the entire profit, 60% will come in P&L account. Last one, intergroup transaction. We have to exclude it separately. Under Indian GAAP also we used to exclude, but there was no guidance creating deferred tax on that. However, under IND-AS, deferred tax also has to be recognized for differences. So, for example, holding company has sold inventory by manufacturing. On 31st of March, it has sold, or before 31st of March, it has sold inventory costing 100 at a selling price of 120. Right? So, holding company has booked a profit of 20 rupees in the financial year. Subsidiary company has acquired this or has bought this. Subsidiary company could not sell in the market. It has in its own inventory. Right? What do? We eliminate profit of 20. Right? Because it's an intergroup transaction. But the profit of 20, what holding company has earned, holding company for its current tax purpose will pay tax of 6 rupees on 20 rupees earned. Right? So that was the Indian GAAP. We used to consolidate 6 rupees tax paid, line by line consolidation, 6 rupees tax expense. Under IND-AS, since this 6 rupees, you have paid tax without realizing profit of 20 rupees. Because that profit of 20 rupees you have, because of intergroup transaction, you have eliminated. Right? You will create a deferred tax asset. So that's an difference. Okay, broadly we have got now just 2 or 3 topics which I thought was going to be important. What we have seen is, if there are holding change without losing control, right, it will be accounted as equity. Now suppose if the holding is not directly by you, but by your associate. So you have an associate, that associate has got a subsidiary, and that associate loses control. Or sorry, it does not lose control, but the control gets reduced from say 60% to 55%. Then the associate, since it is not losing the control, it will account the entire amount as part of reserved non-P&L. What happens at company A level? Should it account that income earned in P&L, or it should also account this as a reserve? So here there is no guidance directly, but both of these are possible. The first view is, since the associate also has accounted this in reserve, so holding company also, or the investing company also has to account in reserve. The second view is, there is no relationship between control and the our company, reporting company. In this case, you can take it to P&L. Both of these are possible, but the guidance issued is whatever you choose, you have to apply it consistently. No, equity method will be applicable, but under the equity method, what happens is, under the equity method also what you see capital appreciation, you put P&L account, right? Now question is, the associate has actually earned profit because of equity transaction, right? Because the holding has reduced from 60% to 50%, 55%. Now that 5% reduction in the holding has been parked in reserve because control has not changed. Question is, for accounting of associate in the investor company, should that 5 rupees, whatever is on, will be part of P&L or will be part of reserve? So here is the accounting for non-controlling interest, share of losses previously allocated to parent. Now what we have seen is, under Indian GAAP, we were not accounting this losses to minority interest. Now under IND-AS, you will be able to allocate this to minority interest. Now again, question is, what happens is on the opening balance sheet date? So if there are negative items, can you allocate or you don't allocate? Now there is no guidance here under IND-AS directly, but if you apply IFRS, IFRS was introduced in IFRS also, the standard was very clear. Till 2011, the standard was changed. The minority were either positive or zero. There also, if there is a negative share, that was not allocated to the minority or non-controlling interest. Now there is a specific requirement. The application when it was introduced for the first time, it was only prospective application. So if there were opening losses, those were not allocated to minority interest under IFRS. Yeah, that can be done. The third is another to acquire outstanding non-controlling interest. So or controlling interest. So for example, what we have seen is, whatever purchase and sale we do for getting the control, that will be capitalized. But if it's a non-controlling, from 25% you are moving to 30%, right? Then what happens to the transaction cost? Or for example, another case, they are already owning the control. So from 60% you go to 75%, right? What happens to the transaction cost of those? So there is no guidance in the standard directly. But what it says is, if you refer to other standard, if the basic cost can be part of P&L, the transaction cost also will be part of P&L. And if the basic cost of investment goes in reserve, then the transaction cost will be in reserve. Right? So these are the few questions I thought would be relevant. And now it's open. Actually, we have ended now in terms of. So if the amount invested, so if the goodwill is changing, then the transaction cost also will be forming part of goodwill. However, whatever you paid is actually debited to reserve, then the transaction cost also will get to reserve. Or if the amount paid goes to P&L directly, then the transaction cost will go.
Amount paid how much goes to P&L?
No, for example, in the case where you are losing the control, right? From 55%, your holding comes down to say 40%. So 15%, what we are saying, will be fair value, everything will go in P&L, right? Now, what happens to the transaction cost of 15%? So in the standard, if you see, there is no guidance. But since we are losing the control, since the entire amount of profit and loss goes to the P&L, then the transaction cost also will go to P&L.
What happens when increasing from 60 to 75?
Right. So there, control is already there. Hence, we are not changing the goodwill. So the transaction cost also will not go to the goodwill. It will go to reserve.
But basic amount
Will go to reserve. Because control is already there. You are not changing the control. Your holding only goes down from 55% to 60%. In this case, whatever amount you pay will go to reserve. It cannot go to goodwill. Similarly, the transaction cost also of 5% will go to reserve, not to goodwill. That's it from my side. I think just to kind of summarize, what you have to forget is the percentage holding. Percentage holding, as I said, is just the first trigger, but a lot of analysis has to be done on the side agreements or on the power, what are the other circumstances under which the company is able to control. There are a lot of new concepts, de facto control or principal agent relationship, ring fencing. So rights are substantive or not. And a lot of work, a lot of analysis will be going now on this assessment. So a lot of senior time is expected at, because since the matter is actually quite subjective, a lot of time, a lot of analysis will be required, as compared to what we used to do earlier. If there is any question I can take.
Most of your questions you asked. When you appreciate the presentation, very exhaustive, all the practical exams, and now it is eager to for that.
At least of course, our presentation was quite exhaustive and Hemal given detailed analysis of the control aspect, which is the most relevant aspect as far as the CFS is concerned. And I must say that Hemal has made a very century in the opening because another topic which we have to take, I think for the work of time we are splitting the next lecture with the information with you. So now I request on behalf of the entire chamber community, participants here and everyone here to have a round of applause.